Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 6th of October and we have as our guest today Kelvin Wong, Senior Market Analyst as Oanda. Now, Kelvin, it's always great to have you on the show.
Sure, Brian, good to see you again and good afternoon.
Now, Kelvin, we've just got news out of Japan on the household spending data, and that's come out better than expected.
Yes, precisely. So let me dissect the household spending data and why is it important? Because we know that Japan itself has been pretty much in the state of deflation in the last 10 to 15 years, and only that about 12 months ago or 10 months ago that inflationary pressure has started to stabilize in Japan. So household spending in Japan is one of the indirect drivers to actually stabilize this positive inflation rate creeping into Japan in the last 10 to 12 months. So what you could see over here is that the household spending for August actually came in way above expectation on a month-on-month figure. So month-on-month for August, it actually rose to positive 3.9% from a negative rate of 2.7%, negative 2.7% in July, and also surpassed significantly in terms of consensus estimate of 0.9% month-on-month. So that's actually a very positive outlook in terms of the household spending in Japan. So if Japanese household manage to actually maintain this rate of upward momentum in spending, that could actually imply indirectly that inflationary pressures have started to stabilize on the upper limit for Japan. That means, i.e., they're able to actually maintain that 2% target, 2% year-on-year target that's stipulated by Bank of Japan. So that could actually push Bank of Japan to actually have an earlier exit from negative interest rate policy as soon as the first half of next year. So how does it implies the FX market? So if you look at the FX market in the last couple of days, especially on Tuesday, there's actually an unconfirmed, we call it news flow that Bank of Japan, under the instruction of Ministry of Finance, to actually stem this multi-month slide in the yen weakness against the dollar that has kickstarted at the start of this year. So there was actually a big slide in the dollar yen rate right below the 150 psychological level. So they almost came down about close to three big figure, 147 to 30. So right now it's actually trying to inch downwards again after this positive, we call it release from the household spending. So in short term, I'll be watching closely the 20-day MA, which is acting as a support right now at 148.25 that managed to help during that rumored intervention on Tuesday as well.
Now, on a different note, Kelvin, today we have non-farm payroll data out of the US later tonight.
Yes.
What is the expectation and how is that potentially going to impact the US stock market?
Sure. So before we start about the non-farm payrolls data, if you look at the last 4 weeks or so, the US stock market has been pretty on the downside mode. I mean, we'll talk about more of a bearish pressure than upside pressure. So for sure, if you look at the current situation since the high of July, the benchmark US stock indices has been trading in a short-term downtrend, and primarily this short-term downtrend has been triggered by the rising longer-term US Treasury yield. Okay, so one of the reasons why the US Treasury yield actually rose at such a steep pace is due to the one speculation that the US central bank, the Fed, will be more likely to be in favor of maintaining a higher level of interest rate going forward into at least the second half of next year. Okay, that's the story. That's the narrative. That's the driver that actually drove this short-term downside pressure on the US benchmark stock indices. Okay, so right now, if the US non-farm payrolls data, which is actually a key economic indicator to indicate the health of the US economy, so non-farm payrolls data, if it starts to came in below expectation, that means that is actually a weak job number. So that could actually at least do a bit of comfort on this rising US 10-year Treasury yield to actually make it to be a bit more of a consolidation mode right below the 4.9% level. Okay, so right now, market expecting right is actually to come in at 170K, so 100K, 170K at a job for last month, way below slightly below 187K added in August. So if it markets come in the Nova payroll data came in within expectation of 170K. So that actually make it close to about 4 months or 4 consecutive months of the job gains that has been at below the 200K mark added. Okay, so it became within this expectation. I do reckon that over here is that it could actually help to put it in a way that to put a cap to at least in the short term for the 10-year treasury bond yield for a resistance to be seen at the 4.9% level, and potentially it could start to be at least a minor pullback towards this 4.7, 4.6% level. So if this scenario starts to materialize, it could potentially add a bit of short-term relief, a corrective rebound in the benchmark US stock indices. So, but however, if you were to ask me whether this level at this point in time is the major bullish reversal for the US benchmark stock indices, I would say that it's still too early to tell. Most important over here is that we got to see what is the expectation going forward in the Federal Reserve meeting, especially the one that is coming up in November.
On that note, Kelvin, thank you very much for your insights. Thanks for coming on the show.
My pleasure, Brian.
Now, we've been speaking to Kelvin Wong, Senior Market Analyst at Oanda on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out this interview on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.